In this video, we look at movements in the US dollar and how that impacts some other asset classes. Since the 2008 global financial crisis, we've seen the US economy lead the globe in terms of restructuring. It was quick to implement QE, restructure its banks, and delever its consumers. As such, it's tended to lead the economy in terms of global growth. This has caused US assets to be relatively more attractive and increased the spread of its rates versus the rates of its global peers. All of this has put upward pressure on the price of the US dollar, which has rallied over 20% between 2014 and the end of last year. The oil industry is one of the main ones in terms of transmitting US dollar price movements into the rest of the asset classes. The US shale oil industry has added more than 5% to global supply over the last few years, and this has put downward pressure on the price of oil. However, the price of oil is also inversely correlated to the US dollar, mainly because around half of the globe's oil is produced in non-dollarized economy, where a strong dollar puts downward pressure on the production of oil in those economies. The highly leveraged and rapidly growing US shale oil industry also put downward pressure on US credit, where a large amount of the issuance of sub-investment grade credit comes from US oil companies. As the price of oil dropped, concerns increased around defaults in the energy sector, and this put downward pressure on credit. While US investment grade credit isn't as exposed to US oil companies, it too sold off along with high yield or sub-investment grade credit, as concerns around the systemic nature of these oil defaults started to cause a general tightening of credit conditions. Credit collapses tend to lead equity collapses, and as a result, more recently we've seen equity markets start to trade in sync with credit and oil. Recent dollar weakness, though, has brought some relief to the price of oil, which has also caused credit and equity to rally. So movements in the US dollar have implications for many asset classes. While the global economic recovery is being driven predominantly by monetary policy, we struggle to see the US dollar appreciably higher or lower from here. As the US dollar strengthens, it puts downward pressure on the price of oil and the price of US imports, both of which bring deflation to the US economy. That's bad for US interest rates, which also put downward pressure on the price of the dollar. As the dollar then weakens, it puts upward pressure on the price of oil and the price of US imports, both of which bring inflation to the US, which increases US rates, putting upward pressure on the US dollar. And so the cycle repeats itself. So in summary, while the global economy is still growing, we think this will likely be led by the US economy, and so we have a slight bias towards US dollar strength. Though while global monetary policy is still the main source of global growth, we see the risks to this forecast as more balanced, and as such, we've recently been repositioning the Global Capital Plus Fund accordingly. Thank you.